The rally we're getting, oh, it's the Fed cut relief rally. S&P up 0.28%, up 16 points. Third session after the Fed pivot. Again, we had a breakout after two failed attempted breakouts above this high right here. We got it right here, and then we back tested. Where we're at right now. I think it's highly probable that we're going to see the S&P top over the next 3 weeks. Historically, that has what has taken place. Could possibly top as soon as this week. We moved to a new high last week. If we get another new high this week, that could be followed by a reversal. We can extend the gains for a little while over a couple weeks and then get a reversal. We're slamming it. We're going up and slamming up into major long-term trend lines on the monthly chart. Highly unlikely we're going to be able to get above those trend lines. Dow and the S&P, I've shown you these charts. But you have to understand something. The market is designed to do as much damage to as many people as possible. I told you I was looking for a bottom over here. We got it with the bullish inside day. I was looking for S&P to move to new closing high. We now have it. In doing so, we're stopping out the short sellers. We're stopping out the short sellers, and right in here, some of the short sellers surrounding the Fed pivot. So we're seeing short covering. Here, when I told you we were getting this sell-off, and I told you I was looking for a bottom, we're getting, with the CPI rally, we're getting short covering. In addition to that, you're getting buyers come in. What the institutions love to do is to make things go down, and then they stop out all the shorts, suck in all the longs, pull the rug out from underneath the longs, and tank the market. What we're probably going to see happen here coming days ahead. Institutions, they are the biggest game players in the world. They get their kicks out of hosing the shorts, out of hosing the longs, create the illusion. New bull market's here, let's go. And again, you've seen the long-term charts. You know where we're at. It's going to be a big rug pull coming. If we get a pretty ugly sell-off, 2022, we dropped 15% in just 6 or 7 weeks or so. These experts are telling us, oh, it's going to be a recession. They're going to tell us, oh, it's an attractive buying opportunity. That's what they said back in 2022 with the first leg down. I'm just telling you, look, looking for a top in here, but we still may go. The S&P continue to try to rally until NASDAQ fills the gap at 20,400. I could be wrong about that. The NASDAQ or the S&P and the Dow peak and NASDAQ, to that level. After that, maybe with an NVIDIA rally or an Apple rally or whatever, just showing you there's a very good chance over the next 3 weeks, maybe it's this week, we're going to see a market top. The market is going to price in recession. We've had the uninverting of the yield curve. After inverting, which is predicting a recession, now the uninversion of the yield curve is warning, hey, recession's here, getting ready to happen. The propaganda, the financial media, and on the internet, oh, rates are normalizing. It's the propaganda, and this is telling you, hey, the steepening of the yield curve, the NASDAQ's getting ready to tank. I believe it's going to go a little higher, fill that gap, in all likelihood to complete an ABC move, and then I think it's going to collapse. The Sahm rule being triggered, which is the 3-month moving average of the unemployment rate being 0.5% above low over the last 12 months. That was triggered 2 reports back. And again, in this last report, we're still 0.5%. And even if it changes slightly, again, it's already triggering, already warning recession's about to happen. The market is going to price that in. A reliable recession indicator. Likely, we're going to push above these long-term monthly trend lines on the Dow and the S&P 500, and the Dow is slamming up into it. There's a little wiggle room if we include or exclude the 2022 shadows. S&P, if we exclude the shadow from 2000, we're just directly under that red trend line, 2750 area. We hit a high at 2733. Include the shadow, we can go closer to 59,000 or 6,000 area. You're going to stall in this area, and I think you're going to stall here probably in the next 3 weeks, as soon as this week. Negative divergences that have formed in the monthly and the weekly time frame. And this midpoint trend line is likely where we're headed beyond the pandemic low for the next bear market low. Probably get a rebound for a new bull market that will give us a lower high, and then 2020s or early 2030s, we're going to get Another bear market that will likely take us down to this trend line low. You can't know that. Yeah, you can know that. All you got to do is look at valuations. This is the Buffett indicator. Market cap to GDP, S&P in red. Market cap to GDP in blue. It's at 195 right now. It's just over 200 right here. Of the tech bubble was at 100, just under 150. Lower high that's set up, which is what I think is going to happen with the next bull market, was 110 or so. Both times it had to drop back under 100 to reset S&P 500. Reset 2020, 2021 because the Fed meddled with the markets and the government gave us a bunch of stimulus checks to create this inflation. Going to be a great reset. I think Warren Buffett's hoarding so much cash. Historical levels for him. Oh no, this time's different. This is telling you the market is extremely overvalued, and it's telling you for the next decade that returns are going to be low or negative. And back over here when you were above 100, again, it said the same thing. The next decade was going to be terrible. What was the next decade? Next 13 years, you didn't make a new high. You went 25 points and then you had another crash here. S&P sold off, rallied up here. We actually went higher, then made a new low. I think with the next market, we'll make a lower high of going down to the long-term channel, back actually to these levels here at around 1500, 1550, 1575 are those two peaks. I'm telling you, the market is at nosebleed levels. Down, it's going to come down hard. It's going to be scary, and then all these people, no soft landing. Could it be a recession? We don't have a crisis going, and we're going to start seeing the market really begin to unravel. People are going to get a rude awakening. It's likely to support the channel with the link directly below. Allows me to be able to provide you this information. If you like the chart, if you like the indicators, then please support what we're trying to do here in providing you this information. If you could take a moment and step up to the plate and help out for just a moment, I would really, really appreciate it. Just follow the link. It'll take you to a secured site. You can donate any amount you want. I just ask that you help out because I don't have any sponsors. I don't want sponsors because I don't want to sell you a bunch of junk. I'll send you to the gold site where they want to charge you triple commissions, and this kind of stuff. People are some shady deals online. I don't want any part of it. Just do what you can to help out. Take the time to do that. I would really appreciate it. We have the 50 above the 200. This is telling us, hey, something's getting ready to happen. The VIX is down 1.61%, down to 15.89. And again, but you have it starting to become oversold again. So again, I think the S&P will complete the topping process at some point over the next 3 weeks, sooner rather than later. It could be this week. 2022 top, where you had the two new highs, the back-to-back weeks there, but then it started the reversal. You get a bigger rally, drop below this low, you could form a divergence on the VIX, on the 200, or the lower band. They're tightening, saying, hey, things probably getting ready to happen. And not too distant futures are still bullish in the daily time frame. The momentum line is still bullish for the S&P. And again, gray shaded area telling us something is getting ready to happen. Over here it was more of a short-term move. Over here it was a bigger move. Still see NASDAQ hit 20,400 and S&P go higher. P may peak before NASDAQ hits 20,400. We'll see. I think the S&P will top at least a pretty good shot of it happening over the next 3 weeks. September, early to mid-October. And NASDAQ looks similar. S&P's making new highs. NASDAQ's not. I think NASDAQ will come back and fill the gap up here on 20,400. I think that will complete a double top on NASDAQ. Warning signs of a top back over here. I told you that on the July 11th reversal, the CPI, that I thought that was a top. Still think that. I got important things to show you. You might want to watch the video all the way through. Very important charts that I haven't shown you before. This is our third session now after the Fed pivot. I think over the next few weeks you can see the top, maybe sooner rather than later. Momentum could begin to roll over. It could also form a divergence if we don't see the the NASDAQ reach the 20,400 area. My guess is that's going to be the case. Wrong about that. Doesn't have to fill the gap. You've got an ABC structure for a double top. Some things to pay attention to. watching these daily charts, watching these weekly and monthly charts, and even the RSI looks very similar to what we had at the January 2022 top in the daily time frame, in the weekly time frame. Watching these things very closely, watching the 60-minute charts closely, and again, S&P broke out, it back tested, and we'll see if it can continue or not. Says it's probably going to end up moving above this high. I think you got a good shot of a peak over the next 3 weeks, maybe sooner rather than later. Already have a divergence on the weekly chart. Once it's complete, whatever top forms, reversal will likely follow. And we got the divergences going on with the Dow 60-minute chart. Not be done yet. I was up 61 points today, up 0.16%. And again, it's forming these multiple divergences in the daily, weekly, and then you've got the diversions in the monthly, and we're up at that monthly channel line. And NASDAQ's becoming overbought again here. Again, still could end up seeing a divergence form, much like what we had at the July top. I think you're probably going to fill this gap at 20,398. Did we go parabolic to reach it, or do we pull back and then go? But I think you could probably get a pretty good shot. That's where we're headed. And I think that will complete an A, a B, and a C structure. Maybe it takes us longer. Maybe it takes us shorter. I think the market could peak late September on into early or mid-October. 3 days after the Fed pivot, could see process complete immediately or take its time. You can see the divergences that are developing. The Dow and the S&P 500. NASDAQ was up 61 points, 0.31% today. Again, had a breakout, a back test. Will it continue to try to fill this gap here? And I think we have a large ABC structure. May just go parabolic, like it went parabolic here, like it went parabolic here and here. These divergences in the weekly and the monthly time frame. Here's a Dow weekly. Look at the divergences forming. Look at the multiple point divergence developing. Channel here, we're slightly overthrowing it, but you have that long-term trend line in the monthly time frame. Again, this divergence is likely going to play out very soon. See the market begin to go back and take out these 20-week moving averages. These divergences on the monthly charts, this is a Dow monthly chart. These divergences led to major sell-offs. This multiple point divergence where you get these series of lower highs. These divergences led to sell-offs, but then now you get another lower high that led to this sell-off in 2022. Now you're getting another one right now, and look at the MACD. It looks identical to the S&P 500. The divergences on the NASDAQ monthly chart, RSI, and on the MACD. Same nonsense we're hearing about AI up at .com stocks. NASDAQ began to take it, dropped 40% real fast. 2 months, rebounded. A year later, just over a year later, it was down 72%. It stopped till it was down over 80%. Well, this time it's different. Poppycock. I've already called a top for the NASDAQ at 11th when we peaked on July 10th. Leading up into that, I thought these trend lines would act as resistance. Wrong about that? Yeah, but you know what? I actually have the guts to tell you what I think before something happens. Very few people have the guts to do that. People call things after they've already happened. I'm talking about a topping process for a long time. I think that's going to come to a conclusion when we fill the gap at 20,400. Then I think we're going to move into bear market and the reversal and eventually get a crash. I think we're in a topping process. Another channel, and why I think we probably have turned. We may go up and try to hit that trend line again and maybe overthrow it and go slightly higher. I guess as we're getting an ABC and we're going to get a lower high, fill the gap, and then I think we're going to come back and take out the trend line right here. Actually, move back to this trend line right here. Actually take that out and the October 2022 low and move back towards the pandemic low way back here and take it out where I think you'll finally bottom. That's going to be over 2024, 2025, completing the topping process now. Start the bear market before the year ends. We'll go on into 2026, all likelihood. Now we had the negative diversions up here with the RSI. On other indicators, this is you're going to get a lower high. S&P 500 monthly chart. It was this channel off the 2009 low. Began the new bull market, gave us the top in 2022. That trend line and we turned down. But we didn't take out the 50-month moving average. So you go, oh, the people that told us this sell-off was never, ever, ever going to happen now called, oh, that was the bear market. Now we're in a new bull market. That is going to extend the bull market. We're gonna now have a bull market going on into 2025 and 2026 with the Fed. A soft landing. We never drop below the 50-month moving average and stay below. You got to have a bear market. You got to take out the 50-month moving average. Oh, we dropped more than 20%. Experts on the financial channel said that's a bear market. This definition of a bear market, you got to take out the 50-month moving average and stay below it to have a bear market. This trend line marked that top. The trend line I'm showing you on the longer term channel from 1929 is going to mark, which we're just underneath right now, is going to mark termination of the bull market. Boys go, oh, that's a bear market. Was this the shortest bear market in history for 3.5 weeks where we dropped 35%? Every single one of these divergences led to a major sell-off. These bear markets over here, the lowest one was this one, 17%. Now you have another divergence. And again, look at these divergences on the S&P, multiple point divergence. Markets, major reversals with multiple point divergences. And again, every single one of these divergences led to a sharp decline, 20% here, over here 35%, over here 27.5%. This one now, S&P is going higher, the RSI is not. The divergence is nearly complete. Same thing on the MACD. And by the time this MACD rolls over, you'll have a crash move already starting. Negative divergences on the weekly chart, negative divergences on the monthly. Creating these long-term channels. Conditions are at extremes. Indicators are flashing. You got people going, soft landing. Repeating what the experts are saying, which their institutions are selling into the rally. Just look at the NASDAQ. Look at the weekly chart of the S&P. Again, same thing here. This looks very, very similar. I've talked about this. This looks very, very similar to what we had over here. Very similar. And again, the MACD and the RSI, they look very similar. So again, here we peaked out after moving to a new high 2 weeks later. Same thing in 2007 after the rate cut. The rate cut did not take us to a new high for a few weeks. In 2007, we were 2 weeks above that high, and then we reversed. The second week, we hit a new high at 48.18, and then we reversed that week. We could see something like that happen here. Could we hit this upper channel line? Probably. Good shot. No guarantee. But again, I'm just telling you, look, I'm looking for a top here in the next 3 weeks. Maybe it happens sooner rather than later. Give or take 4 weeks. Just telling you, look, and it was almost 4 weeks in 2001. I'm just telling you, look, I'm looking for ballpark figure. Based on history, I'm telling you what I'm looking for. The diversions to complete here, that will complete the diversions. Start to reverse on the monthly chart once the reversal starts here. Could we go a little bit higher and hit that upper channel line in the weekly time frame, in the monthly time frame from the 1929 peak? Guesses we're going to go a little bit higher. About my target level between 2750 and 6000. Lower into that target, again, is the 2800 area, I think is reasonable, which would take us up into this area right here. I've excluded the shadows. Maybe we include them. But again, I'm just showing you stuff I'm looking at. Got a really nice looking channel right here. Looking for something like that to happen. Now look at these MACDs. I mean, they look very, very similar. Again, here we started to turn down. Then we turned back up. And we formed this little divergence here. You had the larger divergence from back over here. Very, very similar here. You had this divergence from this peak here and this peak and this sell-off to the 20-week on both of them. Here we had this lower high. Now we're going to a higher high. Here we had this lower high, and now we're going to the higher high. Very similar. And now we're trying to get back above that signal line, burning back up. So again, I think that we're going to see something very similar to here where we turned up, but then it reversed and completed the topping process. At the moment, the histograms turned positive. We have a reading of 0.006. I should just say 0.006. So we're barely in positive territory. So we just barely moved. The histogram's the difference between the MACD line and the signal line. So we're just barely above that signal line, but we're above it. Turning up. I think we're going to turn back below it very soon, I think. We'll likely see a peak in the S&P 500 within the next 3 weeks in all likelihood. These divergences will begin to play out. Pay attention to these divergences in the weekly and the monthly time frame and the channels I'm showing you. They're telling you something big's about to happen. People are too busy shuffling the deck chairs on the Titanic, saying there's nothing to worry about. We're going to have a soft landing. A recession. Market's unsinkable. Titanic. An old recession is not going to sink it. Going to have one of those. Absolutely incredible. That unrealized losses on investment in securities for banks, $512 billion, 7 times larger than what it was during the financial crisis, 2008. Way to make matters worse, coming commercial real estate crisis. Banks have huge exposure to commercial real estate through mortgage-backed securities and directly through loans. Going to be another banking crisis. As the recession, as we move closer to the recession, we start seeing economy weaken, employment rate rise, we start seeing negative GDP, we start seeing job losses, and the stock market begin to price in the recession, and the Fed panic and need to cut rates. You're going to see this eventually be the next financial crisis. We have a credit-driven issue surrounding a recession. This is going to be it. Next one that we have after this session, the debt bomb exploding because the politicians are driving us into bankruptcy. Right now we're spending over $7 trillion a year. Eventually all that's going to come home. Late 2020s or early 2030s. It'll be the next leg down. Next bear market is going to be this bear market. This is what it's going to be surrounding the commercial real estate sector and the bank's exposure. The banks have much more exposure than they did to the subprime mortgages during the subprime mortgage crisis, during the financial crisis there. The exposure they have is huge. Now, all this is coming. Look, another thing to be aware of is things are heating up in the Middle East again. While Israel is dealing with the attack on October 7th in the south in Gaza, 9,000 rockets were being fired at them over the past year from the north, from Lebanon, by Hezbollah. Now they've turned their attention to the north. This is getting very, very intense. I don't know if you've been paying attention to the news in the last week, but just say again, sometimes these geopolitical issues rattle markets, other times they don't. This has the potential to rattle markets more because of the possibility of escalating into a regional war. I don't know that it does. It's just something we should pay attention to. But in late September, on and through October, can rattle markets. Israel is likely going to invade Lebanon, do a ground invasion in the next 2 weeks. Again, just something to be aware of, something to pay attention to. I don't know that this rattles markets, but again, it very well could be a catalyst along with other things. So do keep this in mind. We talk about this soft landing propaganda, and that's exactly what it is. Close-up of charts and talked about the downturn in 2001, or 2000 and 2001 there with the cut in 2001, the downturn in 2007 and 2009, the first cut in 2007. There are other ones. I mean, back over here in the 80s, this is the 80s here into the early 90s. This was different. This was the pandemic. It was a self-imposed shutdown of the economy. But this is a soft landing fairy tale. What is it, 1995, I believe. Kool-Aid drinkers, and it's really, these people are amazing. These soft landing people, it's like a cult. But here, again, this was just part of the larger cycle. Just as this increase over here was a part of the larger, and the increase over here, part of the larger cycle down. This was a part of the larger cycle up. No inverted yield curve here. There was no negative GDP back in the background. That's GDP, and you can see when it goes negative. It used to be the definition until the government decided to change it. I stand corrected. Economic Institute like that definition to help the government out and change things around, kind of like what the Labor Department does with the fake numbers that we get. It used to be 2 negative quarters of GDP. You find a recession, but you get the negative GDP, you get the inverted yield curve, you get the Sahm rule being triggered. Have any of that here. Okay, and this was part of the larger cycle in the 90s called a fairy tale. They didn't move rates down to new lows when they cut right here. the Fed continues to do is they continue to ratchet down rates, try to get the economic expansion until they finally hit, zero. Anyways, nevertheless, I digress. I'll show you this because, again, this is the fairy tale, and it's being compared to, we're going to get a soft, what about 1995? You get these people talk about recession, and they go, this time it's different. And I read saying, the AI boom, it's just getting started in its early stages. The same stuff they were saying back with the dot-com stocks back at the 2000 top and the bursting of the tech bubble. These arguments, this time is different. AI. Other argument you get is, 1995. That's this time right here. Part of the larger cycle. Didn't have the recession warning signals that we have right now. An inverting of the yield curve, and with the Sahm rule being triggered, they're telling you recession's about to happen. The stock market will begin to price in that recession. People like to drink the Kool-Aid. It's just like people right now. We can't market up out and then begin to sell off sharply because we're not in a recession. By the time the recession hits, the market will have already priced it in. Will have begun to price it in. But again, these people that drink the Kool-Aid of the soft landing propaganda. I've never heard such terrible arguments. And you present people with facts that, hey, we're going into recession. Dismiss them. I mean, it is totally like a soft landing cult. The Fed is, and let me just say this, the Fed has blown the bubble so big. You have people going, no, the Fed's just going to come in like they did before. Drop rates down to nothing, bring QE back, and we'll have another bull market in 2020, 2025, 2026, continuing onward, going forward. Can't do that right now. What happen if they bring back QE, which is inflationary, drop rates down to nothing? Inflation would come roaring back. The Fed needs a recession to deal with the inflation problem. I want to show you this soft landing because, we keep hearing it's going to be 1995, it's going to be 2020. They threw all the stimulus at us in 2020, and that's created the inflation problems. Hey, the Fed's policies lead to negative outcomes. The inflation is one of them. They've helped create it. No, that was supply chain disruptions. That was a part of it, but the government passed out $6 trillion in X in the Fed, QE, infinity, and beyond. And you got people out there going, we don't have negative GDP. Markets top on good news. If you go look up the top, you look at the GDP, what it was, 2007 top, at the 2000 top, good GDP. I need the chart from time to time of both of those charts, both of those tops. Eventually, it's going to go negative. This is the snake oil that they try to sell us. This is a soft landing. Didn't have any recession warning signals. It did not lower rates to a new low as they continued to ratchet down rates till they were nothing, and then they raised it, the shortest rate raising campaign in history, and then they dropped them back to nothing again during the pandemic. This is the example that they parade before us, this 1995 soft landing scenario where, we were still in the cycle higher, are so willing to drink the Kool-Aid. And look, the cutting campaigns being associated with the recessions over and over and over and over. We're about to have that now. Like I keep saying, if you dare call out this soft landing propaganda, that's exactly what it is. You can't see. You have a soft landing, then you're a Neanderthal. The institutions promote this lie. Retail investors drink it up, run it up so they can pull the carpet out from underneath them and form another top. Soft landing Y is at every single top. It was back in 2000, 2007, and all the rest of it. We've got recession warning signals right now. We didn't have that back here, and this was part of the larger cycle. We have negative GDP, and another argument is, there's no financial crisis right now. So we're not going to have the stock market tank into a bear market. That's not going to happen. And the financial crisis hit in 2008. The market had long before peaked in 2007. Lehman moment, what was it, September of 2008? Just a year before. In October 2007, the market peaked. It amazes me how much they're so willing to dismiss rational arguments. They want to believe the snake oil that the financial experts are selling them. It's pretty incredible. It's almost like a cult, the soft landing cult. It is incredible. Say anything against it, soft lander denier. You're a heretic in the cult of soft landing. How up there telling us we're going to have a soft landing? He knows we're going to have a recession. You got Yellen out there telling us we're going to have a soft landing. Anybody in social media that says otherwise is a Neanderthal. Claudia Sahm's Sahm rule has been triggered predicting, the thing's been right for decades predicting recessions. But she's denying that. She's talking about a soft landing. That's why I used the example the other day that the emperor's visible clothes and only the wise can see it. Exactly what you have with the soft landing nonsense. Only see it if you're wise. Don't see it, then you're a fool. It's pretty incredible stuff, man.